Hey everyone, welcome back. Today we're really diving deep into something I think you'll find interesting. We're looking at the Vanguard High Dividend Yield ETF, VYM for short.
The one and only.
Exactly. A lot of you have been asking about it, especially with Morningstar being so bullish on it. And I get it. Who doesn't love a good dividend stock, right? But with VYM, it's not just about chasing the highest yield, is it? There's this whole other layer of strategy that Morningstar seems to love.
Absolutely. They're really keen on this idea of stability when it comes to dividends, and VYM seems to check that box for them.
And they don't hand out those gold ratings lightly. So let's break this down. What is it about VYM's strategy that screams stability?
So it's not about chasing the biggest yields. It's more about finding those companies that are, going to be around for a while that can deliver those consistent payouts.
The kind of companies you can actually rely on.
Exactly.
Yeah.
And that's where their focus on large cap stocks comes in. We're talking about the big players, the ones that have weathered a few market storms and come out on top. Right. Makes sense. But how does that actually translate into, a stable dividend ETF?
Well, a lot of it comes down to this thing called market cap weighting. Basically, it means that the bigger the company, the more weight it carries in the ETF. So you've got this built-in balance where the blue chip companies, the ones with the proven track records, have more influence.
So it's kind of like a portfolio within a portfolio.
Precisely. And because those big companies tend to be a little less volatile, it helps to, minimize risk for the entire ETF. Think of it like a giant cargo ship. It's not going to get tossed around by every little wave.
I like that analogy. So VYM is the steady ship. Sailing through those market ups and downs makes sense. But there's one thing that struck me as kind of odd. I was looking at VYM's portfolio and something was missing. REITs. Usually when I think dividend ETFs, REITs are like top of mind.
And you know what? You're right to notice that. It's actually a really key differentiator for VYM.
So what's the deal? Why no REITs?
Well, it ties back to that idea of stability we keep talking about. You see, VYM is really focused on avoiding what we call value traps.
Value traps? Okay, that sounds a little ominous. Like quicksand for my portfolio.
It can be, trust me. Essentially, these are companies with high dividend yields that look really tempting on the surface, but are actually, on shaky ground. Their prices might be declining, and there's a real risk that they might not be able to sustain those dividend payments.
So it's like a siren song luring investors in with the promise of high yields, but it could all come crashing down.
You got it. And VYM's approach is designed to steer clear of those sirens.
Okay, I'm all ears then. How do they do it? How do they avoid those value traps?
Well, they've got a couple of tricks up their sleeve. So first off, VYM casts a pretty wide net. We're talking about covering roughly half of all the dividend-paying stocks out there.
So they're not putting all their eggs in one basket.
Exactly. Diversification's key, right? And then on top of that, you've got that market cap weighting we were talking about.
Yeah.
It acts like a kind of safety net because by leaning on those larger, more established companies.
The cargo ships.
Yeah, exactly. You reduce the risk of getting caught holding a bunch of those high-yield, high-risk stocks that could really drag down the entire portfolio.
Okay, that makes sense. They're really doubling down on that stability thing. But let's talk performance here. This is all great in theory, but how has VYM actually performed for investors?
Well, when you look at the numbers, VYM definitely holds its own. I mean, over the past decade, it's actually managed to outperform the Russell 1000 Value Index.
Which is a pretty common benchmark, right?
Absolutely. A lot of people use that one. And VYM beat it by 1.16% annually.
Okay, not too bad at all. But beating the benchmark, that's kind of the bare minimum, isn't it? What else is there?
Here's the kicker. It did it with less volatility.
Oh, now you're talking. So less risk, more reward.
You got it. But you know what really impressed me when I was reading Morningstar's analysis? VYM's performance during those big market downturns.
Oh, yeah, that's what everyone wants to know, right? How does it handle those storms?
Exactly. And this is where those cargo ships really come in handy. Remember, VYM is built to weather those storms. Take the COVID-19 sell-off, for example. A lot of investors, understandably so, were hitting the panic button. But VYM, it held its own. And even in 2022, when the markets were, let's just say, a bit chaotic, VYM still delivered.
Pretty impressive, right? So it sounds like it lives up to that stability promise.
Yeah, it really does.
But we've got to be real, right? Even the sturdiest ship can get knocked around a bit in a big storm. I mean, VYM must have experienced some losses during those times.
Of course. You're absolutely right. I mean, no investment is completely immune to those market dips. And yeah, VYM did see a pretty significant dip during the COVID-19 sell-off. We're talking around 34%.
Okay, that's not insignificant.
No, definitely not. And there was another smaller dip in 2022 as well.
That's a good reminder, though, that every investment comes with at least some level of risk, right?
Absolutely. And that's why we always say, past performance is not necessarily indicative of future results. But I think the key takeaway here is that even with those dips, VYM has this consistent history of rebounding. It bounces back, and ultimately, over the long term, it tends to outperform many of its peers.
So the name of the game is staying the course, riding out those inevitable dips, and really focusing on those long-term gains.
Exactly.
All right. So we've talked about stability, we've talked about performance, but before we move on, we got to talk about fees. I'm all about keeping more of my hard-earned money in my pocket.
Always a good thing.
What's the deal with VYM's expense ratio?
Well, this is where VYM really shines. It boasts an incredibly low expense ratio. 0.06%.
0.06%. Come on, that's practically unheard of.
It's pretty amazing, right?
Seriously, that's incredible. What does that even look like in, real world terms?
Okay, so let's say you've got $10,000 invested in VYM.
Hypothetically, of course.
Of course. We're all about those hypothetical tens of thousands here.
Living the dream.
Right. So with that 0.06% expense ratio, you're paying a grand total of $6 in fees per year.
$6 a year to have your money potentially grow like that? Sign me up.
Right. Talk about a bargain, especially compared to what some other investment options out there will cost you.
No kidding. So, okay, we've covered a lot of ground here. We've talked about VYM's approach to stability, that market cap weighting magic, their impressive performance history, and of course, those unbelievably low fees. This is starting to sound like a pretty sweet deal.
Yeah, it really does make VYM a strong contender, especially if you're in it for the long haul. But, it's not a one-size-fits-all kind of thing.
I knew there had to be a but coming. What's the catch?
Well, it's not really a catch, more like something to be aware of. Because of how it chooses those dividend-paying stocks, VYM does have some sector biases.
Okay, so what are we talking about here? What does it love and what does it maybe not love so much?
Well, you'll find it tends to lean a little heavier on sectors like financials, healthcare, consumer staples, that kind of thing.
Which makes sense. Those are all pretty well known for their dividends.
Exactly. Now, on the flip side, you're going to see less exposure to sectors like technology.
Interesting. So how should investors be thinking about these sector biases? Is it a good thing, bad thing?
It really depends on your individual situation and your overall investment strategy.
Okay, so context is key.
Absolutely. For example, if you're already pretty heavily invested in those sectors that VYM loves, like financials and healthcare, adding more of it might not be the best move for you.
Right, you don't want to put all your eggs in one basket, or in this case, one sector.
Exactly. You might be amplifying your exposure and actually increasing your risk if those sectors underperform.
So it's all about balance, right?
Precisely. Now, on the other hand, if your portfolio is looking a little light in those areas, VYM could be a great way to add some diversification and balance things out.
Makes sense. So it's not just about chasing those high dividends, it's about understanding how VYM, or any investment for that matter, fits into your bigger financial picture.
100%. It all comes back to your own personal goals, your risk tolerance, your investment timeline. It's about aligning your investments with your vision for the future.
Couldn't have said it better myself. So for anyone out there who's feeling like those dividends are calling their name, VYM seems like a really solid option to explore. Low fees, impressive track record, built for stability. What's not to love?
Right. It ticks a lot of boxes.
But as we've learned today, it's crucial to look beyond the surface. Understand those sector biases, do your research, and see if it truly aligns with your investment philosophy.
Always do your homework.
Absolutely. Well, folks, we've given you a lot to chew on today, but remember, this is just the beginning. Now it's your turn to pick up your metaphorical magnifying glass, do a little digging, and see if VYM deserves a spot in your portfolio. That's all we've got time for on this deep dive.
Until next time.
Thanks for joining us, and we'll see you next time for another exciting exploration of the investing world.